Good afternoon, ladies and gentlemen. Welcome to the John Keel's Investor Relations Webinar for the third quarter of 2023-24. I am Gihan Kure, Deputy Chairperson and Group Finance Director. I'm joined by our Chairperson, Prashant Balendra, who we will together take you through today's webinar, the format of which will be the same as we've done before. Prashant will first give us an overview of some of the key macro highlights as well as some of the key developments during the quarter. And then I will take you through a presentation covering the key financial highlights. And thereafter, we will open the floor for questions. If you have any questions, please enter it in the Q&A tab at the bottom of your screens. So with that, I'd like to hand over proceedings to Prashant to take us through an overview. Thank you.
Good afternoon, everyone. Thank you for joining our webinar. Just to start with the macro environment, in particular for those of you who are joining from overseas, the situation on the ground, I think now is very much normal, and it has been for many quarters, as we have said in our previous webinars, and the economy continued to stabilize. We have seen the currency stabilizing from a low of about 365 to the dollar to about 324 to the dollar by the end of Q3. And in fact, in the month of January, it has appreciated a little more to about 316 rupees to the dollar currently. Inflation has also fallen. It was in the low single digits during Q3. There will be some impact from the increase in VAT and the imposition of VAT on items that were previously exempt from VAT. We can see that impact in our supermarkets in the month of January. And in fact, the Colombo Consumer Price Index for month of January saw an increase of 6.4% compared to 4% in December, 6.4% in January. So there will be a increase in inflation because of the VAT impact, but that is of course short term. We have seen the country's reserves also growing to about $4.4 billion, and we expect that reserves will continue to grow in the coming months. The IMF first review, which was conducted in December, went off well, with the IMF team commenting very positively on what has been achieved with the macro, and the general direction also seems positive. The next big step is to finalize a understanding with our commercial creditors and also our bilateral creditors. Government has indicated that they should achieve that in the first half of 2024. During the quarter, we entered into a partnership with BYD to distribute electric vehicles, which we think is quite an exciting addition. It will come under retail segment, and given the expected shift to electric vehicles and given the market leadership globally that BYD has, we are quite excited about this partnership. The big positive for the economy in the quarter was that we saw tourism recovering. After the events of mid-2022, the recovery in tourism has taken some time, and it was only since the second half of 2023 that we have seen a recovery. And in the month of December, tourist arrivals at about 210,000 was marginally below the peak, which was December 2018, where tourist arrivals was about 250,000. And the trend continues to get better. We are seeing flight frequencies increase, more charters, more inquiries, and our forward bookings are quite encouraging. On our key initiatives, Cinnamon Life and the West Terminal project. Cinnamon Life, of course, the apartments and office tower are completed, the 2 apartment towers. The hotel work is progressing well. We expect the hotel to be partially operational by August this year, and the mall and the rest of the property by the end of the year or early calendar year 2025. On the gaming front, since the announcement of the MOU with a leading international gaming operator, a lot of work has been done on the fit out and the designs, and also on the preliminary planning for the construction, and progress has been positive. We expect that we will be able to make further disclosures on that in due course. On the West Container Terminal, construction is progressing well. You'll see some images when Gihan is running through the presentation. We are looking at the first phase being operational in February 2025 and full completion about a year after that. During the quarter, we announced that the International Development Finance Corporation, or DFC, of the USA has committed to fund the entire debt portion of about $550 million for the project on attractive terms, which is a positive development given the general environment in Sri Lanka. So that was a quick update on the macro and some of our key initiatives. I will hand over to Gihan to run through the details of the quarter, and we will both be here for any questions.
Thank you, Prashant. So I will take you through the presentation, which covers the highlights of the performance for the quarter. The EBITDA for the quarter ended 31st December. We had a growth of 32% as reported, so a very strong quarter in terms of the EBITDA performance. There were some adjustments which I will talk through when we look at the performance here. At SAGT, in our transportation business, we had a deferred tax adjustment last year as well as in the current year Q3. So as a result of that, what we are showing you here in terms of the adjustments is that we had a deferred tax credit in the current quarter of around 400 million, whereas last year we had a deferred tax charge of 760 million. So if you adjust for both those and take that impact out, then the adjusted EBITDA for the group was around 13.3 billion, still compared with 11.1 billion in the last year. So strong growth of 2 billion, and even on an adjusted basis, the EBITDA growth was at 19%, which demonstrates the sort of trend we are seeing with a lot of our businesses really showing growth, as you can see on the table on the screen. This just shows you the cumulative EBITDA for the 9 months. So if you recall, the first half of the year, there were some challenges with some of the businesses, particularly given some of the base effects in our transportation business, which does continue to some extent, and I'll talk you through that. But the rest of the businesses have really shown a strong performance in Q3, and as a result of that, on a cumulative basis as well, the numbers are sort of looking in line with last year, close to being there. If you look at the quarterly movement of EBITDA, from the challenges of Q1 and 2, where the EBITDA from a run rate of around 10 to 11 billion, we did see a decline in Q1 and 2, but now we can see in Q3 that there's a strong recovery. It is somewhat a seasonal quarter because of our leisure business, but if you compare with what happened last year to this year, still, as I discussed, there's been a strong growth. If you look at the exchange rate, as we've seen in Q1 and 2 as well, the rupee did appreciate off the base that we had in the previous year. So this quarter as well, with the rupee being at around 320 levels, compared with last year, which was close to 370, we've seen an appreciation of around close to 13% of the rupee. So that whilst it has its sort of benefits in terms of the stability and the liquidity in terms of the forex market, for some of our dollar denominated businesses, it has been a negative, and that's where we've seen the transportation business, where our ports business, as well as the bunkering business, as well as leisure in Maldives, we've seen that impact on the top line, which has sort of translated to some impact on the bottom line as well. Had it not been for that, these businesses would have shown a better performance than what we are even seeing here. In terms of the finance cost, I think from the peaks that we saw last year, we are seeing that sort of stability or reduction in the finance costs as rates have also started coming off in rupee terms. So if you look at this slide, you'll see some of our businesses, particularly with our consumer business and retail business, where against last year, we've seen a reduction in the quantum of interest cost, fairly sizable in the retail business as well as in consumer. We've seen the other is really the holding company. We've seen a slight increase as we've deployed funds into Cinnamon Life. That's a treasury call in terms of some of it could be slightly higher borrowings as well. So as a result of that, you'll see this impact come through. We've adjusted for the impact of the forex loss on Cinnamon Life, which you see in the next slide as well. And of course, the interest expense on the convertible debenture to Fairfax. So if you look at eliminating those impacts, you'll see still that the finance cost has come down year on year by around roughly 10%. If you look at it on a quarter-on-quarter basis, again, you see that sort of impact again, eliminating both the forex loss at Cinnamon Life. So as we said in Q2, there was a significant impact as a result of the conversion to the functional reporting currency to rupees. But if you normalize for that, we are slightly higher than last quarter on a Q-on-Q basis, mainly due to the holding company and the funding. If you look at the average rupee rates, we've seen that continue to decline, and the average prime lending rate for the quarter was at around 13% compared to 16% in Q2. The PBT for the quarter ended again showed strong growth. Again, a similar adjustment due to the tax impact at SAGT. So I won't sort of walk you through that part of it, but if you look at the rest of the businesses, you can see very strong growth in the PBT number. As we saw earlier, the EBITDA has grown, but also with the finance costs coming off, that has helped the profit before tax of some of our businesses as well. So overall, if you eliminate the SAGT deferred tax impact, still the group has seen close to a 40% growth in PBT for the quarter. In terms of some of our balance sheet numbers, the debt, total gross debt has come down slightly. We have started repaying the Cinnamon Life loan as well, so that has resulted in a slight reduction in the group debt. You've seen the cash equivalents also come off as we've infused some of our cash into the projects. So as a result, the net debt has increased marginally from around 120 billion to 121 billion to about 124. So the total net debt to equity is still comfortable in the mid-30s. But I think the big sort of rebound that you see is from last quarter at around 8 billion EBITDA, where we've now made a jump to around 13.7, which is the significant improvement. In terms of some of our ESG initiatives, I won't go through the details here. We've continued to sort of roll out our One JKH, the D&I brand, and all the initiatives under One JKH. And the foundation also has done a lot of work, particularly in terms of addressing the vulnerable communities and some of our projects and initiatives in that space. Moving on to the businesses itself, I'll just move on to the next slide. Krishan already spoke of the progress on the West Container Terminal. These are just some updated images. We earlier showed you how things have really transformed in terms of all the dredging works and reclamation works being completed. but you can see how now the key wall construction and a lot of activity, and we are on track to complete the 800 meters by the end of this year and commence the first phase of operations soon after. Looking at the current transportation business, we've seen the SAGT volumes grow slightly versus last year. But if you look at the mix, you can see from last year where around 13% of volume was domestic due to the current economic issues and the contraction of the economy. You've seen that number slowing down to around 11%. And as we've said before, the domestic volumes or a domestic transit box gives you much more revenue than a transshipment box. So whilst the overall volumes have increased, this mix change, as well as I mentioned before, the appreciation of the rupee by around 13% has resulted in a lower level of profitability at SAGT. The bunkering business grew profitability. Here we show that we've seen a 9% decline in volumes overall, but as we've said before, last year we still had fuel sales, local fuel sales to the market, and as a result of that, we did benefit from volume. So if you eliminate that, the decline in volumes is only around 1%, and we saw better margins as a result. We saw the EBITDA of the bunkering business improve. Moving on to our consumer business, in our ice creams business and soft drinks, we saw volumes being largely in line with last year Q3. So the frozen confectionery ice creams business essentially declined by marginally by 2%, and that's sort of the similar decline that we saw in Q2 as well. The beverages business was flat, very marginally down compared to last year. In Sri Lanka, we had a lot of unseasonal and very unusual weather in Q3, particularly in the months of October and November. And as a result of that, we did see a significant impact on volumes in both these businesses, because these businesses are driven by the fact that people will consume as they move around, and the heat is there, so obviously they consume more. So with October, the very unusual rains, we saw a significant impact. But the good thing is, in the month of December, we saw both businesses, as the weather normalized, starting to show recovery. And despite the issues in October, we still ended up the quarter pretty flat in terms of volumes. And that momentum of the recovery that we saw in December has essentially continued through in the month of January as well. Overall, the EBITDA of the business in terms of margins did show a slight decline from what we saw in Q2, but still much better than the 6% or 8% that we've seen before. The reason for the slight decline is, as I said, the volumes were flat, so there is some margin contraction on account of higher costs. The sugar tax in the country, which was levied, increased from 25 cents to 50 rupees, and as a result of that, there is an impact. We've taken steps to increase our prices, but those price increases really, in terms of taking effect, would take place only from around December onwards. So there is a lag effect in terms of the repricing and the recovery of our margins on that front. We've also seen a slight mix change in the ice creams business, which is not a permanent mix change, but as I mentioned before, with the weather impacts, we saw a decline or the mix change more towards bulk and slightly less impulse. And the impulse gives us a higher revenue per literage, as well as higher margins. So as a result of that, we've seen a slight decline in the overall EBITDA margin of this business. As Krishan said before, we've seen the VAT increase from 15% to 18% from the 1st of January. So there is some impact there as well, where we've looked to reprice some of our products. In the ice creams business, we will look to reprice some of it post-April. So there is a little bit of a lag effect in terms of how we recover margins. But overall, we are quite encouraged by the volume recovery momentum that we've seen from December through January. If you compare the numbers compared with last year, it's still a very strong recovery that we've seen in EBITDA, and the overall recovery of the EBITDA margins that we've seen have been heading in general in the right direction. I won't spend too much time on this slide, but this is just to show you, as we've done before, how the input costs have sort of declined. There are slight upticks quarter to quarter, but overall still compared with the peaks that we saw last year, we've seen that decline, and it's sort of stabilizing at these levels by and large. If you look at the frozen confectionery business, again, very similar sort of number that we've seen. We've seen the energy cost, of course, in both businesses as a percentage going up. We've seen that sort of impact on margins because we've essentially seen 3 different price revisions or increases in the electricity tariffs over the last year or so. And as a result of that, we've seen the proportion of energy costs in this business go up. In addition to even our retail business, which I'll talk to you about later. The other thing just to highlight here is that this number of the raw materials directly imported shows at 33 and 61% compared to last year. The reason for the 33 is that given some of the challenges last year with the import limitations and the shortages of foreign exchange, these same items were still procured, but procured locally. So that's why you see a disparity in that sort of number, whereas the 55 to 60% is sort of the actual importation input into our production. In our retail business, we've seen the trend continuing with same-store sales being in the double-digit territory, again driven by strong footfall growth. So we've seen about a 16% growth in footfall, which translated to a same-store sales growth of around 11%, because we've seen ABVs decline. And this is something we've spoken of before, with inflation in the country coming down or being even in the negative territory. We've seen that impact on baskets, and I'll get into the details on that in the next slide. So despite the contraction of ABVs, we've still had same-store sales growth of close to 11%, driven by footfall. And as we've said before, that's quite encouraging that we continue to see that sort of growth in footfall driven by higher penetration, as well as it shows the sort of long-term potential for this business to keep sort of improving its penetration. Overall, the EBITDA in the business was marginally higher. The supermarkets business was essentially flat. Here again, the electricity impact was quite significant considering the outlet network that we have. And if you sort of look at the margin impact of that, it is quite material, where we had around, I think it's almost a 1% impact on the margins if you look at the increased impact as a result of electricity. Had it not been for that electricity impact, we would have seen a fairly strong growth in our EBITDA. We've taken many measures in terms of trying to mitigate this impact. We have solar on all our outlets as well as our distribution center, and we're looking to optimize our energy efficiency in every area possible. Just looking at the decomposition of our retail supermarkets business, as I said, same-store sales was at close to 11%, driven by footfall. So we've seen, of course, we've had seasonality there, but overall, we've continued to ensure that our volumes have grown through the footfall growth. If you look at our ABV, we've seen ABVs decline by around 4%. We've seen inflation being in the positive territory, so inflation at around 4%. But despite that, we've seen ABV growth, ABV decline, driven by a decrease in the weight of purchase, or essentially the number of units that are purchased by a consumer. And this is as a result of a decrease in the discretionary spend. We've seen a significant increase actually in the fruit and vegetable prices in the country, again mainly due to the adverse weather conditions. And as a result of that issue, we've essentially seen the quantum of or the quantity or the value that one would spend on a basket has increased towards the essential items, which leaves less for someone to spend on non-essentials. So that has essentially reduced the weight of purchase, and as a result of that, we've seen the decline in ABV. As we go forward, I think we are expecting, with weather normalizing as well, that the fruit and vegetable prices will start to decline, and that would mean an increase in the rest of the sort of discretionary spend of our consumers. Krishan already spoke of the BYD, the agency or distributorship that we've got. So it's a area that aligns well. As he mentioned, this will be reported under our retail business, given the synergies of the business as well. We've got 133 outlets. So part of it is about building the ecosystem of the charging stations and building the confidence around that network. And we are confident with other properties around the group as well, the locations across the country, and our supermarket network, that will be able to build that ecosystem. This is well aligned with our group sustainability initiatives as well, in terms of bringing in new energy vehicles into the country, which is something we believe will be a positive for the country as well, given how much of fossil fuels are used for transportation purposes. Moving on to our leisure business, we've seen, as Krishan mentioned, the recovery trend continuing. We did around 210,000 arrivals in the month of December. It's still a little lower than we saw in 2019. So 2019 was a fairly normalized month post the Easter Sunday attacks, which was in April that year. So still around 10% lower than we did in 2019, but still overall numbers are heading in the right direction. If you look at the momentum that we're seeing in the month of January as well, it's somewhat along those same lines. Like to see the recovery trend sort of momentum gathering pace, but overall forward bookings and the outlook looks quite positive. In the Maldives, again, the overall numbers have shown a strong growth. So if you look at it over last year as well, for the month of December, the quarter, there was strong growth. And if you look at the numbers for calendar year 2023 versus 2022, there is a strong growth, as you can see, which has continued through 2024 Jan as well. In terms of our leisure business, driven by the increased tourist arrivals, we've seen our Colombo hotels and Sri Lankan resorts do well. So if you look at it against last year, occupancy increased quite significantly, as well as ARRs, which resulted in an improvement in EBITDA margins. Similarly, in resorts, we've seen a significant increase in occupancy and better ARRs as well, which brought in our EBITDA margins into positive territory. In the Maldives, if you look at it Q3 versus Q3, the numbers are broadly in line, a slight decline in occupancy, but an increase in ARR. So overall top line growth and EBITDA margins being in line with Q3 last year. So we've seen an EBITDA increase mainly driven by the Sri Lankan recovery, and that trend is expected to continue. As I mentioned before, the appreciation of the rupee is relevant for this business as well. But of course, that base effect or adjustment will sort of start falling away, because we started seeing the rupee appreciate from Q1 of last year. So, Q4 of last year. So that base effect, we won't see that sort of impact as much going forward, assuming the rupee remains. In terms of Cinnamon Life, I think we've got a few updated images of the project. Construction is progressing very well, and the fit outs are continuing. Krishan already spoke of the gaming operations and where we are in terms of progress with the designs and groundwork to start the fit out. So I won't get into the details of that now. In our property business, with Cinnamon Life, we haven't, as we have said in the past couple of quarters, seen a lot of traction in terms of actual conversion of sales in Cinnamon Life. So it's been a little slow, but as we've said, as we get closer to project completion, we've seen the inquiries increase, and we're very confident that we will see demand and conversion of some of these leads and conversations we're having translate into sales. With Tizen, we've seen we have around 200 units, good momentum. We are seeing good traction of sales in that segment. We spoke last quarter of suburban development Viman. We've sold 74 units and SPAs have been signed. The first phase of the project, so we are doing it in sort of a modular fashion, which de-risks the project and really doesn't require any capital upfront into the project. So we have around 40 more units to be sold in the first phase of the development, which comprises of 114 units. These are just some images of what the Viman project will look like upon completion. In the financial services business, we've seen these are the Q2 numbers because both these businesses have a financial year end of 31st December. So their Q3 numbers are yet to be published. But we've seen the EBITDA growth driven both by the insurance business and Nations Trust Bank. Profitability at UA was driven by the surplus of the life insurance surplus against the previous year, as well as higher interest income on government securities. And NTB also saw growth in profitability. There were lower impairments as well as higher fee income. So that brings us to a close on the presentation and this component of the of our discussion today. I'd like to open out the floor for questions. So if you have any questions, please enter your questions on the Q&A tab at the bottom of your screens. Krishan, just in terms of, I think we already spoke of the leisure business, but maybe a little more color on just the forward bookings and whether we are seeing a change in the composition of the arrivals as well.
Yeah, I think the forward bookings, as I said, are quite strong, and we expect that each month will be better than the previous month. So month of January, just taking the country arrivals, the final figure is not available, but it would have been about 210,000 arrivals, and that would compare with the peak, which was January 2019, which was about 240,000 arrivals. If you look at the composition in the third quarter compared to a previous, pre-COVID Q3, the Chinese numbers were significantly less. China was pre-COVID the number 2 market into Sri Lanka, behind India, and the numbers from the traditional Western European markets were also less, not as significantly lower as China. But we are seeing that change. Numbers from Western Europe are improving, and the Chinese numbers are improving as well. So when I look out over the next 4 months, we will see some change in that composition.
Okay, thanks. There's also a question, Krishan, in terms of the Maldives, that pricing across the quarters has been at a slower rate, and occupancy seemed to be stagnating, and whether Maldives is showing up signs of peaking as a destination.
No, I think numbers into the Maldives have increased overall, but you're seeing a lot of people going into the occupied islands, into the guest houses. So it's not tourist numbers coming into the star-rated hotels. What I mentioned about Sri Lanka, that the Western European numbers have been lower and China has been lower, and that is continuing to impact even in the Maldives. The Chinese numbers are not back to pre-COVID. Western Europe is getting better, but still not back to pre-COVID, and that is a higher spending segment. So that is where we saw some impact in Q3, but in fact in Q4 looking at the bookings and what we've done in January, that is seeing a more normal level of room rates and occupancy, more comparable to pre-COVID. In fact, we expect that in Q4, our overall room rates in the Maldives will be better than Q4 of the last financial year.
Thanks. There's a question on when we can expect the BYD vehicles to be on the road, as well as what type of capex we will have on the BYD operation. I think in terms of the government policy, first we need the government to open out the market for the importation of vehicles, and with that, then we will be able to start operations. So it all depends on government policy itself. But we are still doing a lot of the groundwork in terms of establishing our operations and what the groundwork that we need to do in that regard. The capex itself is not very significant. It's a distributorship, so it's essentially trade facilities based on customer orders that you import the vehicles, and the rest of the infrastructure is more just about showroom operations and the servicing aspects, which are not very significant. So it's not a very capex heavy business at all. It's just the trade lines that you need, which is more working capital, but that also is based on customer orders. So we don't see that to be a significantly working capital intensive business either from our perspective. There's also a question about the initiatives to mitigate margin pressure on the retail business, the centralized warehouse as well. So I think in that regard, we have seen the centralized warehouse actually contributing a lot towards improving our margins, the type of scale benefits, as well as other efficiencies that come through. Like I mentioned before, the key impact on our business was really the electricity impact. So we're doing everything that we could do to mitigate that impact. Of course, we're seeing growth on the top line, and we are also looking at how we can drive margins through the mix, private label, negotiations with suppliers, and so on. But we've seen overall margins heading in the right direction. Krishan, just getting back to leisure, maybe thoughts on the imposition of the minimum room rates, and has it been positive to the business and how we see it going forward?
I think it's a mixed impact. We felt that really room rates should be left to market forces. There is an impact in that the minimum rate attracting the MICE segment, especially from India, is a challenge. And with when the room rates were introduced, we were anyway seeing an improvement in business traffic and tourist arrivals. And then we went into the season in December. So you can't really compare it with last year, for instance, to see whether the minimum rates really had a positive impact. But there is some negative impact because it impacts certain segments, like what I mentioned, like the MICE segment. So it's hard to comment whether it's been positive for the other segments in terms of increasing room rates overall. But as I said, our preference would be at a time when occupancy in the city until November was running at just 50%. It's better to start filling the rooms and getting some momentum, and as demand picks up, then taking room rates up. That's been our position.
Moving on to the transportation and ports and bunkering business. Have we seen any pickup, Krishan, in terms of the volumes with the onset of the Red Sea crisis? And is there any sort of long-term benefit that we could see in Colombo as a result?
From what we can see, it's more a short-term benefit. There is some impact on container volumes, but the bigger impact is on the bunkering business. So the month of January, we expect that Colombo overall would do about twice the volume that we would normally have done. And so the LMS volume would also be would double what we would normally have done. But that is likely to be more short-term impact, a positive impact because of the Red Sea situation. At the moment, we can't really see a long-term positive or negative impact.
I think there's a question on the impact on, there are a couple of questions addressing the same thing. I'm not sure whether anyone missed the initial presentation, so I'll maybe repeat it for those who joined midway through. In terms of the impact of volumes in the beverages and ice creams business in October and November, and how we expect the volumes to trend going forward. So as I said before during the presentation, we had very adverse weather conditions, unusual rainfall in the months of October and November, particularly in October. And as a result, we saw an impact on ice creams and soft drinks business. There was also a question in terms of whether it had an impact in our supermarkets business. It does to some extent, given rainfall on particular days. But unlike, say, soft drink or ice cream, which is completely discretionary, and if you don't have it on a given day, you won't consume more the next day. Supermarkets, people may not shop, but you do end up going because you still need some of your items. But overall, it does have some sort of dampening effect, but naturally less so. As I said before, we've seen normalization or recovery in volumes in December as the weather has normalized, and we've seen that same momentum continue through January as well. As we both said before, we've had the VAT increase from 15 to 18%, and some items, of course, have gone up from 0 to 18%. So we'll need to really see the impact, whether it has a significant impact on consumer discretionary spend or not. It's mainly the 15% going up to 18%, but there can be some sort of pass-through impact which could affect discretionary spend. So that's something we've got to monitor and see. There's a question on giving a little more clarity on the Viman project, how revenue is recognized. So essentially, it's a similar model where we'll have deposits and then sign sales purchase agreements and get cash. We will start construction, as we've said before, upon reaching around 70% of that total sales value of the 114 units, and then revenue will be recognized throughout the project based on completion and cash collection. So similar to the model that we've done with Trizen or some of our other projects other than Cinnamon Life. Again, on consumer, there's a question on the steps we are taking to sustain volumes, lessen the negative impact, and the sugar tax. So as I said before, with beverages, we have already passed on selected SKUs. We passed on the impact of that tax increase from around December onwards. So that's why we saw that impact of margins in Q3 because we started to see the benefit of that price increase having a lag effect from around December. But in ice creams, we will evaluate the pricing strategy. We head into the peak season in April, and given that it's a frozen business, we start having to sort of stock up and manufacture and ramp up our operations right now. So any price revisions, we will have to just look at it in terms of the timing that we would review those pricing revisions, taking into account the VAT impact as well as the sugar tax impact, and naturally monitor what our competition is doing as well. Krishan, is there any interest for inorganic growth in the insurance business given the opportunity if it arises?
Yes, we would in the life insurance business, which is where Union Assurance plays. We would be interested in an inorganic opportunity, and it's something that we are actively studying and pursuing.
Related to that, Krishan, there's also a question which I think we've addressed before, whether there are any SOEs earmarked for divestment that the company is planning to bid on.
No, I mean, we are looking at all the opportunities, but there isn't anything specific that I can comment on. Obviously, if it's something that is a fit with one of our core businesses, we would be keen to look at it.
Thanks. The Fairfax convertible debenture is eligible for conversion from the 12th of February onwards. There's a question whether there's any indication on the conversion dates. We've spoken of this before in terms of the likelihood, Krishan, any clarity that we can give?
No, there is no firm indication on the conversion. Of course, the bonds are in the money in the sense that the market price is now significantly higher than the conversion price, but there is no firm indication of when it would be converted.
There's a question on whether the regulator has suggested that NTB will need to raise capital. I think all the banks, there are capital adequacy ratios, and looking at the scenarios and how much capital a bank needs. As we've said before, NTB in terms of its capital base has been quite well placed, looking at all the different stress tested scenarios. The banking sector has now come out of a lot of that uncertainty itself. So the need for capital actually will be dependent more on asset growth, and depending on that strategy, then the bank will need to review its need for capital, but otherwise the bank is well capitalized. In our supermarkets business, there's a question on when the outlet expansion plan will resume. We never completely we did say we'll slow it down and evaluate our expansions very critically in terms of stress testing each and every store and so on. So it's not that we put it to a halt. We added one outlet. There are a couple in construction. So that will continue. It's just that the pace of that is not as fast as we were looking at a couple of years ago, purely because of the construction costs, as well as just ensuring that if we stress test these, finding the land takes time. So we just want to ensure that any construction of a new outlet will withstand all those sort of stresses or volatility. And as I said before, when I presented the retail business, we can clearly see the footfall growth, the trend that we are seeing in the business. So the density that you can have in terms of increasing the outlet penetration and the conversion to modern trade is very much an underlying factor that will continue to drive this business. But naturally now, with interest rates coming down and inflation also settling, we could look to possibly ramp up the pace of the outlet expansion a little bit, but subject to the evaluation criteria that I mentioned. There's a question, Krishan, on what's happening to the phone business at JKOA with the imposition of VAT and increasing competitiveness of the grey market. Any comments on that?
The imposition of VAT was from the 1st of January, so that's an 18% impact. So it will, have an impact on volumes, and it will benefit the grey market. So it's something that is unavoidable when there is a further difference in prices between the formal market and the grey market. So yes, we expect volumes to be lower, at least to begin with, over the next few months because of the VAT impact.
There's a question on the operations of gaming at Cinema and Life in terms of what type of arrangement we would have. So as we've said before, it will be an arrangement where essentially Cinema and Life will act as a landlord, and we will be renting the space out to an operator. And as we've said before, we've already signed up with an internationally renowned operator. So the operator will run the operations and essentially pay Cinema and Life rental, fixed and variable rental. That's the structure we're looking at for essentially being the landlord of the property. There's a question on the investment that we had done, which is not a material investment in the bottling and canning facility, and whether we are going to be entering into that segment. So it does enhance our capacity in our beverage line without having to make a significant investment in expanding our own pet facility. So it gives us additional de-risking in terms of our volumes, as well as now gives us access to being able to do some level of canning. It's early stages of that market, but it's also an area where we'd like to start getting access into that segment. There's a question on the occupancy levels of the Sri Lankan hotels and Maldivian hotels, and whether it's improved on a quarter-on-quarter or month-on-month basis. I think in Sri Lanka, we spoke, when I went through the presentation, we saw a slight decline if you look at it on a quarter-on-quarter basis in terms of our Sri Lankan resorts, but ARRs are higher, and as a result, the financial performance is much better. There were some impacts in terms of we had higher group numbers coming in as well in Q2, as well as, of course, it's off season in the East Coast. So one of our properties which saw peak volumes in Q2 would see an off season in Q3, but less that. But I think we've seen some impact as a result of seeing higher volumes in Q2. And yes, despite the overall numbers increasing, we have seen the occupancies slightly lower, but compensated that with much higher ARRs, and that's been part of the strategy for some of our properties at least, which resulted in better financial performance. There's a question, Krishan, on how Cinnamon is positioned to face the rising competition from alternate lodgings and luxury chains coming up in the Maldives. As we said, of course, the guest houses are a completely different segment, and whilst that doesn't directly attract numbers away from the hotels because it's a different segment, what we've said before is that the numbers, when you look at the total arrivals number into the Maldives, it can be a little misleading because part of those arrivals would actually be patronizing the guest houses, and as a result, the segment that's actually coming to the star class hotels may not be showing the same growth as we look at when we look at the headline numbers. So it's not really a question of those hotels necessarily taking demand directly because the pricing points are different. But having said that, Krishan, there are other chains also, other hotels that have opened up in similar classes of star classes as our properties, whether we see that as a threat and how we will respond.
I mean, it's been the case for some time in the Maldives. It's not a recent phenomenon. For the last 15, 20 years, we've been competing with more established brands in the 3, 4, and 5-star segment, and Cinnamon has got some recognition and some strength and developed a niche of its own, and we've had very good occupancies throughout the last so many years, despite having to compete with the much larger and more established brands. So it's not something recent that more brands are coming into the Maldives and something that we have to adapt with. We are continuously focusing on improving our service levels, our processes, our marketing and distribution, and we will continue to adapt as the environment changes. But new brands coming into the Maldives is not something new in terms of competition that Cinnamon has to deal with.
Can we comment, Krishan, just on the elevated Port Road and how that is progressing?
Yes, elevated Port Road is progressing. It's one of the few road projects that have continued to see construction in the last 1 year since the issues of 2022, because it's funded by the ADB, and expected full completion is, I believe, September this year, September 2024, and we can see the construction continuing, and it's the last couple of kilometers now that need to be completed. So it appears that it will be completed on time.
I think we already commented on the progress at the West Container Terminal. So I don't think there's anything further unless anyone has further specific clarity on the progress. But as we've said, we are on track to complete phase 1 of the project by the end of this year and commence operations thereafter. There's a question on whether the land bank has increased in any way during the quarter. There is no increase in the land bank. The Viman project is done on an existing land that the group was occupying. So actually, by starting the project, we will actually be able to monetize that particular land, because the project itself will essentially recover the cost of the land as well as the profit from the project. So we'll be monetizing the land bank, which in effect over the years will reduce that component, but we have not expanded the land bank of the group during the quarter and don't have plans to do so either. I don't have any other questions with me at the moment. I think we've got only a couple of minutes remaining. And hopefully we addressed all the questions that everyone did pose. So we can conclude today's discussion. Thank you very much for joining the JKH webinar. The recording of this webinar will be available on our website shortly. So anyone who didn't watch the entire webinar will be able to download and view the proceedings in a couple of hours. Thank you once again for joining the JKH Investor Relations webinar. Have a good day.
Thank you.